Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. If you're new with us, we have to go through this wonderful disclosure. That's the two words put together. I won't waste time reading it to you. There is two important things to note, though. Again, if you are new, maybe take a screenshot and read it at your leisure. But the main things is we are not registered to offer individual investment advice in the United States, and any pricing that we talk about, unless noted otherwise, is denoted in US dollars. Those are the primary things that the regulatory people want us to convey to you. So again, not trying to make light of it, take a screenshot of it and read it when you have time. For those of you that may be new, just to give you an idea of how TradeFinder works, we do the intro. I will take a few minutes to go through and update everybody on where the market is at this point in time. Then we will look at any current case studies that we have closed for our subscribers on our website. And then we'll look at an update of what we've identified as case studies for this TradeFinder, because we're kind of keeping a running tab on finding a case study consideration, if you will, each week. And then we'll look for some new ones for this week. And with whatever time is left at the end, I'll take questions. So that gives you a brief rundown, and we'll try to respect your time. And I'll do my best not to do as I normally do, which is run on well past time. So with that said, let's go ahead and take a look at where we are currently in the market. It's been a pretty couple interesting days, to say the least. Starting this week, we had the Federal Reserve come out and say that they are going to continue their liquidity injection now by buying corporate bonds in the secondary market. And sometimes there's terminology that's thrown around and not everybody is familiar with what that means. The secondary market is basically the exchanges. That's us buying and selling, like me and you. When you go open up your brokerage account and you go to buy something, somebody else is selling it. That's the secondary market. The IPO is the first market, and then the actual exchanges is the secondary market. Prior to that, they'd been a little vague on what they were going to do with the corporate bonds. They said they were going to buy them, but they were more focused on buying them through ETF type of securities. Now they're just going to go into the marketplace and buy corporate bonds, which is pretty amazing, really, when you think about it. And so that gave the futures a bit of a jolt. We also have a new infrastructure stimulus package. It hasn't gone through Congress yet, but President Trump has authored a $1 trillion package. So that's more additional stimulus. The retail sales came out today and absolutely blew away expectations, but that's the May number. And they were expecting about a 7% increase, and it came in at 17%. So it was more than double what was expected. That one's a little bit different. I mean, the jobs numbers, surprising and stuff, people coming back to work, you can kind of see where you could get some surprising numbers along those lines. But to have retail sales jump like that, because people have been home. So, maybe people were worried about their jobs and not spending as much or whatever. But it's not like people weren't buying things. The numbers haven't been that bad since the whole shutdown thing started. But to have a big increase like that coincides with people going back to work. So you had a better than expected jobs number, and then now you have a better than expected retail number. It sounds like the consumer is back to work and happy and spending again. And so that put a little bit of a bid into the market as well. So all kinds of things going on. And then we get guys that come on the financial networks that are talking about how, hey, we have a long way to go to get back to where we were, and kind of throw a little bit of water on the fire. But we'll see how things play out over the next few months. I live in Florida. We're kind of deemed as a hotspot now with new COVID cases. The interesting thing is they expected the cases, even with reopening the economy, to not be too severe in the summer months, because the warmth was supposed to suppress the virus a bit. And two of the hottest spots in the entire country are Florida and Arizona. So that kind of doesn't jive with that game plan of the warmer weather suppressing the virus a bit. And two of the hottest states in the country are warmest states in the country are having the greatest number of outbreaks. But the expectation is towards the end of the fall for things to really get severe. We'll see how that plays out. You hear all the conspiracy things and whether or not the numbers are real, all that kind of stuff is playing out. But we live in interesting times, to say the least. There was a comment on the YouTube video about when I was talking about anarchy, and I was talking about mainly people protesting about the government shutdown, about being told they had to stay home. They couldn't go to work, businesses couldn't open, and now it's kind of branched out into other issues as well. So it's interesting times, to say the least. As far as the market is concerned, if you watch the last S&P update, and we do those on YouTube, I imagine that the vast majority of you are familiar with those, and we appreciate you watching, giving us a like, hitting subscribe, etc. We had this move here called an island reversal. Well, that was given credit to, yes?
At the moment.
Oh, okay. Sorry about that. Better now? We all good? Seeing the screen now? Yeah, we're working with the tech people to help show better videos, etc. And I'm still obviously an old school guy trying to learn new technology to help everything work a little bit better. So I apologize for that. But here's the chart. And what I was showing you was we had this drop down here that gave us, this is known as an island reversal. That occurs when you have a gap in one direction, in this case a gap up, followed by a gap down. That's known as a bearish island reversal. The problem with island reversals, and if you read about them and do some research, they'll say that they can last anywhere from a few days to a few months. My experience has been that they really don't last all that long. So I haven't experienced one personally. I'm sure that somebody could point out some charts, etc., of when you've had an island reversal that did last months. To me, they haven't lasted all that long. We moved back to the upside today. The high of the day was at the open. And we also had some positive news, and I don't know how much of that. I mean, we seem to have had that a lot. I think there are positive expectations of some sort of a vaccine or a treatment for COVID by the end of the year that's going to be effective. So every time we get a new news item, does that jump the market to the upside? My viewpoint is that I think it's more other factors, like the Federal Reserve saying they're going to come in and make sure that the liquidity pumps are flowing and that the credit markets are working. That's what happened in 2008 and 9 when we had the big move to the downside, is the credit market shut down. So that's crucial to keeping the economy going, keeping business going, and therefore keeping the stock market functioning. So I put less weight into the, I did a tweet today, and I talked about a triple whammy for the rally today, and I didn't put the news about the COVID drug in there. If you haven't followed us on Twitter yet, you can go to our YouTube channel, look at any of the videos on YouTube, and in the notes section there, you can find the way to follow us on Twitter. Maybe the support guys will put that up as well. But looking at the chart, we almost closed this gap. So if we close that gap, that negates any sort of a further downward move on the island reversal. So where does that leave us? Before I show you what Elliott wave and the Fibonacci levels are saying, let's do a quick poll. We haven't done this in a while. For those of you that have been watching for a number of weeks, we used to do this fairly often, and we've taken a few weeks off. So let's put up another poll and say, where do you think we'll be by the end of the week? So we're at Tuesday night. Where do you think we'll be at the close Friday, higher or lower? So where do you think we're going to be, higher or lower by the close on Friday, or the same, or roughly the same? In other words, some sort of a sideways move. I had some people that were saying that, hey, I think we're going sideways from here. Possibly, but let's see what we come up with. Boy, it is amazing. The audience that we have here is so indicative of how the markets work, because we're almost even across the board between bullish, neutral, and bearish. It's amazing. That's what makes the market, because when you look at the comments that are on the YouTube videos, people are so passionate about their views, whether they think the market's going to the upside or whether they think it's going to the downside. They are committed. They are, this is what's happening. They're not even like, this is my opinion or whatever. They're, this is what's happening. And so it takes a buyer and a seller on any transaction, not just the market itself, but on any transaction to make a trade. You have to have both sides of the market covered. And so we're basically split across the board. It's a third between bullish, neutral, and bearish. So very fascinating and really indicative of how the markets work. So let's look at what Elliott Wave might be thinking. Now, last week we talked about the fact that we were moving into some pretty thin air here, and I think we had like a pilot or something came on and was really specific about how this actually works. But we had this ascending triangle or pennant pattern that was building, and it was getting thinner and thinner, and it looked like we were getting ready to have some sort of a move, and boy, did we, to the downside. And having these three, look at the size of these bars compared to where we were. The intraday volatility here on each of these 3 days, even today, if you count today, has been higher than the last large day that we had back on May 14th, a full month ago, since we had an intraday volatility the way we've had over the last 4 trading days. That's expected when you see it getting with the bar small and a vertical move. You're tending to get to the point where you're quiet and you're time to calm down. Now, if you looked at the last S&P video that I did, I labeled the charts pretty specifically with this downward zigzag that we had, followed by the upward zigzag, followed by a flat. So I'm going to go through this very quickly. Just watch that video if you want to see more of that. And then we had this upward move, and so I'm not going to go through all that, but up to here was the upward zigzag, and then we went into this flat pattern. So we had a flat, and when you come out of a corrective flat, and a flat is a corrective pattern, quite often, according to Elliott, you would get what's known as a thrust. And so that's this move here. We talk about that. That's a thrust move. It was a pretty vertical move, more than the 45 degrees. If you get a breakout that moves like this, more in a 45-degree angle, those tend to hold. In other words, they don't correct as much. You don't have as much of a move in the opposite direction when you have a 45-degree angle move. You can see this is much more severe than that, almost vertical, not quite, but almost vertical, which left it ripe for a correction and a little bit of an island reversal that we had. So what I wanted to show you was, if we take a look at this and we start from the low here, let's actually use our really cool new zigzag tool, and you can see that we had right at a 50% corrective move from that thrust, which gives us a potential now upward zigzag with the 100% level taking us to new highs. Now, we had talked about in the past how this upward move negated a qualified downward zigzag that we had back here. And again, I just don't want to repeat myself when there's all the videos detailing these things already on our YouTube channel. So when you take a look at that, you'll see that we had a qualified downward zigzag that has been negated. So you look for the new pattern. And one of the things that occurs when you have a corrective pattern that's negated is the previous impulse becomes retraced. And that would be a move back towards the recent highs. And we were headed that way. We just got overbought. Let's look at the moving averages. You can see how overbought we were from the 10-day moving average. No security in any time frame. It's very far away from the 10-day moving average. How many times have you heard me say that? So we've corrected that and come back down. And for 3 days, we were below the 10-day moving average. We held at the 50-day, which is that royal blue line. And then today back above the 10-day. And look where the high was. That opened dead on the 38.2% fib level. That's a resistance point. Market couldn't break above it in today's trade, but we'll see what happens over the next few days. But this is setting up like, not only are we going to move back and retest those highs, but if this zigzag works out, and it doesn't become fully confirmed. It's actually a pattern that you can trade once you have the B wave correction. But if you want the highest degree of percentage accuracy, you wait for that A to be taken out. So once you get there, then you trade that last move. So you can see that takes a lot of the move out. So it's far more of a conservative entry, but you would have a higher percentage of accuracy if you waited for that. But it is technically qualified from a Fibonacci standpoint right now with a 50% B wave correction. So we'll see. We could also, you can make a real good case that we just didn't quite get there today, but that, and let me take all this other stuff off. You could certainly make a case that with this island reversal, we're going to come back up and fill this gap and then head lower, because in filling this gap, we also fill this one. We still have one here that needs to be filled. So it would be a legitimate argument for somebody to say, well, hey, this is just a bounce from an oversold condition. We're coming up, we're closing these gaps, and then we're heading lower in what we talked about was a qualified, in the larger degree, a big flat to the downside, which basically is something like this. So a couple of different things, a bigger pattern that's over the longer term, shorter term, we could see that zigzag play out. It's fascinating to see what happens in the market. My point is that you have to be flexible. The markets change, so you need to be flexible with the markets. And let me give you an example of here is our website, and one of the alerts that we sent out to our subscribers was on Google. So this, again, on our website now, we list all of these trades and everything. We have a graph here. So we mark to market every one of our alerts every day. We're as transparent as is humanly possible in what we do in posting our alerts. I mean, you see all kinds of people posting things of, well, I did this and I did that. And so it's like, okay, great. Tell us where we can find it. Because I'd love to see where it was posted rather than, you just saying you did this. Anybody can say they did anything, but putting your money where your mouth is far more important. And we list everything here. So you can see how a trade works throughout the point in time. You can also see an indication of how crazy the option pricing has been, which is why maybe we haven't been quite as active through this volatility time as some might have, others might have been, or maybe might have hoped that we've been. I've been doing this for over 25 years. You learn a lot in 25 years of trading, and you pick your spots. You stick your toe in the water, you take a little gain here and you back. That's how you last. That's how you survive and make money over long periods of time, not just trying to get in. I'm sure you've seen it on the news with all these Robinhood traders and the people that are buying penny stocks, et cetera. There's a lot of that going on right now, and guys talking about I'm a better trader than Warren Buffett. And there was a guy they interviewed on CNBC on Friday talking about he was better than Warren Buffett, and he obviously took some flack about that. It's so reminiscent to me of 1999 that it's not even funny. Just be careful. Be careful. I hope everybody's making money. I want everybody to be successful trading in the markets, and everyone to come in and see the benefits, the lifestyle, the freedom that trading for a living can offer one. But it isn't that easy. Okay, it's just not. And when you have people saying, there's a post that, I made 170%. I was born to do this. No, you weren't. Nobody was born to do this. How you become successful doing this is educating yourself and going through some pain, letting the market educate you, or signing up for a service, something like ours, where we educate you as you go, and you have the opportunity to follow along with trades rather than letting the market just teach you. Anyway, here's the Google trade. We entered this. We sent this out as an alert. And I did it again. As soon as you came in, I realized that. I apologize. Sorry, everybody. I'll get it down. Old dogs with new tricks. We'll eventually figure it out. All right, so here's our website. This is what our website looks like, and every trade has its own trade ID. Here's that chart that I was telling you about, which is the mark to market right here. There's the chart, and if you click on it, it actually brings it up and shows you where the position was each and every day. Now, what I was mentioning as far as the craziness in the prices, as you can see, it down 130%. Well, it's a fixed risk trade. We only do fixed risk alerts. We don't sell naked options. We don't put anything where you can lose more than what you put into the trade. So it's impossible for it to be minus 130% when it's just the original trade. It just shows you that's how wild the options pricing has been. They widen the spreads like crazy at night because and a lot of people have identified this, that the futures have been bizarre overnight at times with massive swings. And so the market makers are widening the spreads, not knowing what could happen overnight so that they don't come in and get, handed to them on the open the next day. So that's where you see some of the unusual things. And that's what I was talking about as far as when you see option prices that are crazy like that, what can happen to you is you can be right on direction and still lose money on your trade just because of how the option prices are working. There's a lot more to trading, especially trading options, than just getting the direction right. So we want to make sure that we're covering all our bases, and that's what we've tried to do. So here was the alert that was originally sent out. Here was the chart pattern. Make sure that showed up. Okay, so here's the chart pattern of the out of the money butterfly. We had the stock moving to the upside. There was a gap on Google that needed to be filled. The DMI, which is one of our favorite confirming indicators, was giving us a signal that there was some strength to this move. So the expectation was we were going to come up and fill this gap and possibly retest the highs. So we set up the out of the money butterfly. In other words, that was the target range. Now, the beauty of an out of the money butterfly is Google doesn't have to get within those wings. If it does, and the closer you get to expiration, the exponentially higher the return is. But an out of the money butterfly takes what is normally known as a range bound sideways strategy and makes it directional in nature. So it allows you to profit if the stock starts moving your direction, whether or not it makes it within the wings. When you put on a traditional at the money trading range butterfly, you need that stock to work its way in between the wings and stay there. So staying between the wings of the butterfly is crucial. But when you place them out of the money and make them directional, you can make money just on the directional move, just getting the direction right. It doesn't have to move within your wings. So it's a great strategy. We utilize it often when we can. Utilize it a lot over the years on Google. I was thinking about this when we close this out. Google's probably number one. Probably had more alerts over the years go out on Google and probably made more money off of Google than any other stock. It just happens to be one of those. I think it's because it's really liquid that Elliott wave patterns follow and work a high percentage of the time. So we expected it to move higher, and it did. We sent out the closing alert on June 10th. Let me make sure you're seeing that. And you can see that we got up to the point where we almost filled the gap. We hadn't quite gotten there, but we almost filled the gap. Well, why didn't we wait till we actually filled the gap? Well, we had over a 75% gain in the position already. And what's going to happen as soon as it closes that gap? Is there going to be an intraday reversal? Would we go up and tip that gap and then turn around? You can see we were forming a bit of a doji on that day as well. So a number of things came into the mix, not to mention the fact that the market was showing some signs of getting tired to the upside. It was a June position, so there was a limit to the amount of time frame. The beauty of a butterfly is you don't have to go way out in time because time decay begins neutral, and as you approach expiration, actually works a little bit in your favor depending on where the stock is in relation to your trade. So that's a pretty cool thing with the strategy. So we decided to go ahead and take the gain, which, as I said, was better than a 75% gain that occurred in just 18 days. Now, if we take a look at where Google is now, and I'll switch over to where you can see the chart. I'm getting the hang of this now. Really, every time I change the chart, I have to change this window. That's how this works. So you see the chart now. You can see that for 3 days after we close the position out, look like absolute heroes because not all, but the majority of the profit was gone in the position. Now we bounced back up today, and there's a chance that we could see this stock run up and get within the wings of those butterfly and the butterfly by Friday, which is expiration for June. If it does that, then it would have been an absolute home run, and you can play the Monday morning quarterback of, oh, gee, you should have waited. Yeah, well, how would you have felt about that? You know, back on the 11th when we had over 75% gain here, and then almost all of it was wiped out overnight. Probably wouldn't have been feeling too good about that. So my point is that you can generate really good gains in the butterflies. If you happen to catch one where it moves up closer to expiration, yeah, you can have some pretty amazing returns. But how greedy do you want to get? 75% in 18 days? That's pretty darn good. Let's just take that, be happy, and not fall into the greed standpoint, and then just move on. So that's where we were, and we are showing the screen, right? So let's do a quick rundown of our other case studies. TSM, this one we actually closed out for our subscribers as well. So this one was one that we had sent out. I'm going to bring the details of this one up for you and show you on our screen. Just give me a second after I bring it up, and I'll switch the screen over for you. And because this one we closed out Wednesday of last week, so the day after we did the webinar. So here's TSM, again, off of our website. So it shows you, and this is a really good example. This is how these strangles work. So this one's in our volatility strategy. The Google trade was in our impulse strategy. This is in the volatility strategy. So those are our two primary portfolios. The impulse strategy, for those of you new, is mostly directional in nature. And the volatility strategy is primarily strangles, where we find consolidating stocks that look like they're about to move. And I'll show you an example in a second. Now, because we're buying a call and buying a put, in this case, the October 55 call, October 45 put, right from the beginning, time decay becomes an enemy and the position shows a loss. So if you have several of these on and you look at your account, you've got several trades, all losing money, and thinking, well, what am I doing? This is stupid. This doesn't work. Yeah, it does. That's the nature of the trade. That's how it works, is that you show a loss until the breakout occurs. Exactly like how this screen here shows. Let me make sure that you're seeing that. So just like that, it shows a loss until the breakout occurs, and then you get the big move to the upside and the profit. So that's how it works. Back to here. So here was the position. The entry alert was sent out to our subscribers on May 20th. And this was a really pretty decent looking symmetrical triangle. When we started, big move to the downside, bounced up into a consolidating symmetrical triangle. My favorite pattern, whether you have a vertical move up or down, that then corrects into a consolidating triangle, a symmetrical triangle. My favorite pattern. We had resistance up around 60 and we had support down around 44. Really nice setup for one of our proprietary type strangles. And it worked well. And then we exited the position on June 10th. Let me show you the chart screen there of why we closed the position out on June 10th. Because you can look at it and say, well, wait a minute. You said that you had resistance up there at 60. Why didn't you wait till you hit 60? Why did you close it out when the stock was up at 58? Well, the reason is, look where the 10-day moving average is, the lime green line. So the stock broke out, and now we have pretty good separation between where the stock is and the 10-day moving average, which brings that no security in any time frame, gets very far away from the 10-day moving average. we had 2 gaps lower to be filled. So if the stock was to come back down towards that 10-day moving average to correct the overbought condition, might have just saying, well, let's, on the way down, let's just go fill those 2 gaps. Well, next thing you know, the whole profit is gone in the position, and now we're waiting again. And the longer we wait, the further the stock has to move for a profit. It doesn't mean that we can't still generate a profit. It doesn't mean that we can't still generate a nice profit. It just means that we have to wait longer and be patient longer. And in doing that, we're giving the stock time to maybe not break out as volatile as it did. We already had it there. So this one generated a really nice, roughly 30% gain that occurred in 20 days. And this one, I'll show you the chart, the current chart of this one as well, just accountability, right? Because you can look back and say, hey, were you right? Were you wrong? What did you do? I still go back to the fact that nothing wrong with taking a profit and being happy with that. So whether or not you look back and say, oh, you could have waited or not, we'll see. There was a lot of time left in the trade, but it broke quickly. And we had a nice gain in a very short period of time. I just don't think there's anything wrong with ever taking that. So let's bring the chart up. And here's the window for the current chart. And this one also. Looks like we've made a pretty good exit. You can see, that we have been kind of going sideways since that vertical move and correcting that overbought condition that we had. We came down and touched the 10-day moving average. There you go. That's what happens. So far, we haven't come down and filled those 2 gaps that we worried about, or that I was worried about. We basically filled that one, but we still have the lower one here that hasn't been filled yet. So that was one that we had given out, not just as an alert to our subscribers, but we also followed that in the TradeFinder webinar. So I wanted to update you there. Also, one that had preceded TSM was Costco, which was starting to show a bit of movement. You can see it looks like we were breaking to the downside out of the triangle. It did move back up today, but look at the day today. So looked like we're starting to break down. Doji here yesterday, another doji today, 2 dojis in a row. Something's getting ready to happen with Costco. There's a lot of indecision around Costco right now. So I think that there's a pretty significant move getting ready to happen. I don't know if some sort of a news event's about to come out or what. Maybe they have an earnings on the horizon. I haven't even checked to see when the earnings report is, but we had looked at this one for our group. So I wanted to update you there. MNST from a couple of weeks ago, show you that one. We actually sent that one out as an alert to our subscribers as well. Was doing extremely well, had a very nice gain. You can see it was in a wave 3, came back to the wave 4 corrective level, hit a 38.2% correction. Would have liked to have seen it come all the way down to 38. Would have felt better before the bounce, but it's bouncing now. And if the market continues to stay strong, futures are down 8 right now. That's nothing. In this day, just an 8-point move. So we'll see what happens before the market opens tomorrow. But a little bit of a bounce back to the upside. So that position is looking well. HSIC. And then last week we looked at Apple. Somebody told me last week, I think this stock had gotten downgraded, I think is what caused the move, but now it's turned around, come right back up. So since we've been doing TradeFinder, this stock, HSIC, sets up to be the first losing case study that we've had. But now it's rebounding, so it could turn around and come back up and end up being a winning trade as well. But otherwise, all the rest of them have been winners. You can go back and look at the recordings to see how far back TradeFinder goes. So we're certainly due for a losing position, but maybe this one's not going to be in the end. We'll see how that plays out. And then Apple was last week. So here's Apple in a wave 3 with a potential target up around 390. So the 9th was last week. So here we were talking about this last week, and I was mentioning that of all the ones that we looked at, this chart looked the best. I didn't like the fact that we had a big up day on last Tuesday, and we were getting some separation here, but yet it was just too good of a chart pattern to ignore. And boom, we got even more overbought the next day. So that was Wednesday. Then Thursday we came back, tested it, bounced off the 10-day moving average on Friday, again yesterday, and then back to the upside again today. So we are, let's see, where were we on the close at 343? Last week we're at 352. So we're 9 points higher than where we were last week when we identified this as our case study. So what I'm trying to show you is that we're being accountable, not just on our website for our subscribers, for the trades that we send out, the alerts that we send out, just from what we're showing you here in the TradeFinder. We're trying to be as honest and open and accountable as possible. So, you know, our record speaks for itself, I think, and that's where the merit is based. So with that said, we have a few minutes to look and see if we can find one for today. We go up here to the scans, come down pre-computed scans. Our subscribers that also have this software enjoy the fact that you can utilize the pre-computed scans, and the scans that I utilize, we did a whole web series on this, if you participated in it, called TradeScan, where it actually was identifying each of the confirming indicators that I utilize. Elliott wave option is the main thing. That's the primary indicator that we utilize. But I don't think any good technical trader would ever tell you to rely on only one indicator. And even as good as Elliott wave is, I would never tell anybody to rely solely on it. So we have a set of confirming indicators that we utilize to identify opportunities. Then we apply Elliott wave to it. And that's what we detailed in the TradeScan series. And so we went through those. And then the next web series that we're going to do is focused on Elliott wave. And boy, it's intense. It's a lot of stuff. So here's the bullish stocks. And if we click on that, you can see there's only one result. And that's on ZTO. So click on it. Now, obviously, with the market moving back to the upside, as it has, this move back up that occurred today, you would think that you would get more results. But remember, we had 3 downward days. Basically, the second day, Friday, was a little bit of a move back to the upside, but we had lower highs and lower lows for 3 days in a row. That's not going to be conducive to finding good results on our confirming indicators. But this move back to the upside, we actually looked at this one a while back, didn't we? I think this one was one that we had identified in TradeFinder several weeks ago. It gives you the indicators here. So we just go through and take these off. We know that it's showing that it has strength. Then we apply the Elliott wave. It's in a wave 5 at a 40% extension. We are trading at roughly $36 was the close. That's a pretty good move. I didn't think it was actually going to be that high originally looking at it, but the target price is just under 41. So you've got almost a 5-point potential move here on ZTO. And just bring the DMI back up. That's the primary one to look at, and the ADX looks good. That's one of the first things that I look at is where is the ADX? What's that chart look like? Where is it in relation to the 2 directional indicators, which is the DMI as a whole when you put all of it together? But I'm mainly interested to see where's the ADX and what's the angle of the move. So when you see the ADX curling up that hard, that means that there's significant strength to this move. In other words, what we're trying to find here is do the confirming indicators support a potential continued move to the upside, a la what Elliott wave is saying, which in this case, the answer would be yes. Elliott wave is showing that we have potential extension for almost $5 more, and the confirming indicators are telling us that, yeah, there's support there, there's strength to this move. So then we'd come over here. Surprised at this. We might give you a bonus one here because it was something else that I wanted to show you that people have asked to look at, and then I said I would look at tonight, and then we'll take questions. Not the most liquid stock in the world, but there is liquidity. It jumps from July to October options. I wish we had September. We don't. There's plenty of liquidity in July, not as much in October, but some. You wouldn't be trading by yourself. So, yeah, and the spreads aren't, yeah, they are a little wide. Spreads are a little bit wide, but it's so hard to know if that's just an after hours occurrence or if the spreads are that wide in general. All I can tell you is that when the VIX elevates like this, at least I haven't noticed it anywhere near this bad over the past couple of decades. But this time, right now, the spreads and the option pricing is off the map. It's all, you have to be really, really careful because the pricing makes no sense compared to what it should be doing. So let's look at a couple things. So the ZTO is going to be our case study, just to confirm, for this week. So I'm going to make a note of that. So keep a written record of everything that we're doing. And the things that people had asked that I promised to look at, first of all, was gold, which I wanted to show you the chart of gold because I find this is interesting. So we first look at it like, not very exciting, but I actually think there is something pretty interesting to look at here. So when we look at the DMI, we come down here, the ADX is low. I like to see the ADX at 13 or below. And when you have a VIX, where do we close on the VIX today? $33, almost 34, pretty much in line with where it was at yesterday's close. You don't get too many ADXs dropping below 13 when the VIX is above 30, is my point. So it's nice to see that. And we've been trading SLV for our subscribers because GLD has been ahead of SLV. SLV has been catching up. You can look at charts that compare them, and you can just go back and look at daily returns. When the metals move, silver has had a higher percentage return on a daily basis than gold has. So we've been trading that. But either of the metals, with the type of liquidity the Federal Reserve is injecting, is a place that you want to at least have part of your portfolio if you're being smart and being balanced about your overall portfolio due to inflationary pressures that could come down the road with all this liquidity. But it's exciting to see an ADX below 13. That's my point. And then we look over here and we have this sideways channel right here. So it's pretty sideways. And then look at what's happened just recently. You can see that we've got just a bit of a symmetrical triangle. Now you might look at that and say that's a pretty crude drawing. It looks like an arrow, doesn't it? But even though this is sideways, it's still consolidation. When you get a sideways pattern, the issue is you don't know how long it's going to go sideways. So that's why when we talk about the triangles that we put on for our subscribers, we're looking for triangles that are about to yield a breakout. A sideways pattern is a consolidation pattern, but it can go sideways for a while. You can have double and triple flats where you have months of sideways movement. The problem is if you knew that, you could put on an at the money butterfly, but you don't know how long it's going to stay. So it works both ways. You don't know how long it's going to stay sideways to put on a sideways trade. You don't know how long it's going to stay sideways to put on a breakout trade. So they're challenging. I find that trading flats are really hard. It's the hardest part of LA Wave, in my opinion. But in this case, we've kind of moved to the point where, all right, we've been consolidating, but maybe we're getting to the point where something's getting ready to happen. And I can tell you that GLD is probably pretty close to Google as far as the most number of alerts that we've sent out per particular security symbol. We've had tons of Google trades, but an awful lot of GLD, both of them in different portfolios, which is interesting. So if we viewed it as number one in each portfolio, Google would clearly be the number one in the impulse pattern portfolio, and GLD would be number one by far in the volatility, in the strangles over the years that I've been trading. So I think that's pretty interesting, and I think that warrants a pretty good look, especially with the ADX as low as it's been. If we had the ADX higher, we'd think, well, that could be a signal that we might need to go sideways for a while longer before it breaks out. But with the ADX that low, I think that's getting ready to move. So talked about looking at that, and also was asked to look at the dollar. So let's look at the dollar. And we had this triangle pattern here. We've moved, looking at the December contract now in the dollar futures. So there was a breakout, and we've kind of stabilized here. If you're a currency trader, you probably weren't, well, it depends on what side of it you're on. But Stephen Roach, who's one of the few people that I have a lot of respect for as far as coming on without an agenda and really trying to give good analysis of the markets. I think he's a really smart person, and he thinks that over the next few years, probably a pretty good chance of seeing, if not a full-on, a near collapse in the dollar with all of this Fed liquidity. That's his opinion. I'm not saying that's going to happen. I'm not saying the charts are showing it, because they're not, but that was the opinion that he gave, and you can Google it and find out. Stephen Roach, R-O-A-C-H is his name. So that's not good. The U.S. dollar, Chairman Powell was talking about it today, because they were asking him, are you worried about hurting the dollar with all this liquidity that you're injecting with all of these programs that the Federal Reserve is doing? And he said, no, the U.S. dollar is the currency of last resort. It's the strongest currency. It's the one everybody wants. Well, that's true. That's why they've been able to get away with what they've done as long as they have. But can they do it forever? I just don't think so. But that's just a common sense thing. And the market doesn't always follow common sense. So who knows what's going to happen down the road. So I do share the concern of where is the dollar going to be a few years from now. But maybe the rest of the world is worse, and maybe the dollar is much higher. You could make a case for that of, well, where else do you want to be? The Fed fund futures are saying that we may have negative rates in December. I talked about that in a video a few weeks ago, and that could change things. Most of the world is already at negative rates. We're one of the few places where we aren't at negative rates, which makes it pretty compelling, a pretty compelling place to look to buy, invest. So we'll see how long this plays out. There's conspiracy theories of, what if other countries got together and tried to create a hybrid currency? Blah, there's all kinds of stuff out there. But there's the dollar. It broke to the downside. It's consolidating a bit now. And, where it goes from here is hard to say. It did what it was supposed to do. We were talking about this symmetrical triangle, and that we were going to get a breakout. We did. See what happens from there. Looking at the actual metal on gold, bring up gold here. This is the June contract on gold, and you can see kind of that very similar pattern that I showed with GLD. So it's almost identical. You might even say that, well, this is actually even a better symmetrical wedge than what GLD is, maybe not quite as horizontal of a sideways consolidation here as we had with GLD. So that could be showing an even greater move. And then last but not least, I was asked to look at TLT. And then I'll open it up for some questions. So here's TLT. We usually look at TBS, which is the inverse of TLT. So when you look at TBS, which I like to look at, it's like rates. This is the price of the 20-year TBS or TBT, excuse me. TBT is the inverse, which is actually a reflection of the rates. So price versus rates. And the patterns, as you would think, are roughly the same. So let me show you TBT and you'll see what I mean. So this is the ultra short, so it's the inverse. And where this broke to the downside, that broke to the upside. So TLT broke down, TBT broke to the upside. So there you get the inverse and the opposite. But when you look at TBT, since it's the inverse, you're actually seeing are rates going up or going down. Rates went up. That was okay because rates had gotten so low, it was showing or foretelling economic weakness, which we don't want. But we don't want rates to go too high either. So there's that Goldilocks scenario where you want rates to go to the upside, but not extreme, because then it starts to hurt business. So we want rates to be high enough to where they're showing that the economy and business is healthy, but not so high that it begins to hurt it. So there's the happy medium of the Goldilocks scenario that we talk about. And so then back over here to TLT with the pricing. Prices drop down, prices go down, rates go up. And then back up here to the midpoint, that happens a lot. This is actually a really good example of what happens a lot with triangles is they break out and they come back and they test the breakout. In other words, it comes right back to where the breakout point is. And then you get an idea of where the move is going to be for the future. And if we're wanting the market to go to the upside, you don't necessarily want to see this move to the upside either. Because that means if this is moving to the upside, then that means rates are going down and we want some support. So today's move coinciding with a solid move in the equities makes sense. Not that the markets have made a whole lot of sense in recent weeks or months, but you always want to look at where's the equities market and where's the bond market. Pay attention to the bond market. That's one thing that I like to tell people is that if you want to be a good trader in the equities market, whether you're trading equities themselves or trading options or whatever, you need to have a good understanding of what's going on in the bond market. There's more money in the bond market than there is in the equity market, and there's very smart people in the bond market. So it usually gives you a little bit of a tip of the hand as to what's likely to happen in the economy 6, 9, 12 months down the road. If you follow the bond market, it's very important. All right, let's see. I've got time. We'll get a few questions, and then we'll wrap things up for this week. Take a look at Mr. Softy. So we'll do that. Question was, look at Microsoft. MSFT is the symbol. That's showing my age. Back in the late 90s, they used to call it Mr. Softy because of the symbol, MSFT for Microsoft. Put the Elliott wave pattern on. It's a wave 3. And the question was, it hasn't broken out quite yet. And going back a ways, Microsoft never did anything. We always joked about how Microsoft was probably the most sideways stock that existed. It moves better now than it did, but this is the kind of stuff that we used to see back in the late 90s and stuff, just nothing, absolute dead sideways. So it broke up, came back down, tested that, it's moved back. It is in a wave 3. Let's look at the DMI and see if that's confirming it. The DMI has been going sideways for a while with the ADX, so it hasn't shown a whole lot of interest in this move to the upside, but we're testing the previous highs, and the ADX is trying to move up. Two directional indicators are creating some separation, so it looks better now than it's looked for weeks and weeks as far as the potential to move to the upside. It's trading at 193, could go to 210 or so. So we'll see, but it needs this DMI to continue on what it's shown the past day or two, where it's looking like that's trying to broaden out a bit. This is no good, where we have this sideways, I call it a snaking pattern, where it's just going sideways and the directional moving indicators are going up and down, but in the end, it's just weaving sideways, like a snake going through sand. You know, if you've seen the snake, the way it slivers through the sand, the snake's going straight, but you have the lines going back and forth. It's an identical pattern, but in the end, it's the same thing. Snake's going sideways or straight, and so this is going straight sideways as well. David says dollar down, stocks up. I agree with that to a point. Certainly when the dollar goes down, it's great from a currency exchange rate for multinational companies. That helps earnings. That's always been viewed as a very good thing. It's just, where's the tipping point where the dollar goes down so far that it's showing that the economy is really bad? Maybe it never gets there. Maybe Chairman Powell's right. Maybe they can do whatever they want and they can manufacture as many trillions of dollars as they want out of thin air, and it doesn't matter because it's still the best place to be. I hope he's right, because if not, it's not going to be good. So we'll see. But you're right, when the dollar does weaken, that's positive for the bottom line of a lot of international companies. Let's see, this is, does it need to go down to wave 4 before it goes up to 208? Are you talking about Microsoft? I'm not, was that Microsoft you were talking about? Okay. No, that's good. I'm glad you asked that question. Comes up all the time. When you see this wave 4 here, what the software is doing is telling you, because we're in a wave 3, right? The hardest thing to forecast is, where does a wave 3 end? Shouldn't say that. It's the second hardest thing to forecast. The hardest thing to forecast is, where does a wave end in a corrective pattern? Whether or not you're dealing with a flat zigzag or triangle, where does A end? Hardest thing to calculate in the world of Elliott wave. Where the wave 3 ends is number 2. But what this 4 is saying is that if the wave 4 were to start now, that's your targeted pullback range based on all the rules. Now, if the stock goes higher, this targeted 4 range will move based on it. It just stays with the math of the formula that Elliott himself wrote. So this is not showing you, this is not saying, this 4 right here is not saying we're in the wave 4, we're starting the wave 4. That's not what it means. It's giving you a target. If the wave 4 were to start now, that's where it's likely to go. So I'm glad you asked that, because I try to clarify that as much as I can. It's a common thing that's asked. David saying the gold, the GLD DMI is bad. Well, remember, the ADX is down really low. That's what we want, because we're looking for a breakout. We're not trying to say that GLD is breaking up. Let me be really clear about that, in case I cause some confusion. The chart of GLD is showing it could break up or down. I would agree that the DMI is not looking good for an upside breakout. The ADX is so low, it's saying that it's trendless, but that's what we want for a potential breakout. So the idea of GLD was a strangle. It looks like it's getting ready to break out. It could be up or down. So I wasn't trying to say that GLD was looking good to break to the upside. If I created confusion there, I apologize. My point was that it looks like it's getting ready to move. I don't know which direction, but it looks like it's getting ready to move. So good questions. Question on Akamai. Symbol is AKAM. And the question was, how should I trade it? Well, I'm not allowed to give individual investment advice. I can't do that. So I can't tell you what to do, but I can take a look at the chart pattern and analyze the pattern. And that's a good symmetrical triangle. We actually have an alert on this for our subscribers. And again, as a subscriber, basically you get all the same education that we're going through, much more in depth than what we do in these free events that we do with the YouTube videos and the TradeFinder series. but we take the education much deeper, and you get alerts. So, I mean, if all you got was alerts, that's fantastic. That's what people want. When we send out trade entries on to actually specifically with the actual option strikes, pricing, everything, any adjustments, and when to exit. Because I know there's some services that only do entries. They don't do the exits. Oh, that's no good. You could say you exit at any time. Monday morning quarterbacking is 100%, 2020. You got to send the exits out too. So you get entries, adjustments, and exits, alerts, all that, and all the education as well. And then the ability to send questions to, we have a great support staff. And if there's a question that needs to come directly to me, you can send questions directly to me as well. So I'm not just waiting on me to respond to some video or anything else. You can send a question directly to me if you would like. But as far as Akamai, I can't, again, tell you what to do, but I can say that is a great pattern for a breakout. We do have an alert for our subscribers on the potential for breakout, and I think we're going to add to it. It's just way too good of a pattern. It looks like it's really ready to move, and you can see that where we've come from. We're over 100, and granted, that was the low when the market made its low, so that was an extreme, but it shows the potential for movement all the way down to 75, and then we had been at 85 and ran up to almost 105 before the bottom fell out of the market and all this virus stuff and everything started. So Akamai is a stock that can move when it wants to. It likes to consolidate and break out. Maybe not as much as GLD does, but it likes to do that. So that looks really good for some sort of a strategy like a strangle that would profit on a move in either direction. The DMI is showing that the ADX is low. So again, there's no directional signal being given there. And look how low that is. Remember I said I liked it below 13, which is nice to be able to have ADXs below 13 when the VIX is at 34. That's even below 11. So that's what I'm saying is that looks really good. And then we're probably going to just add to that in the volatility strategy for our subscribers. A couple more, and then we'll wrap things up. Craig asked to go back on the original, looking at the market. And let me try to be clear on what we're talking about. As far as the market, that was yesterday. Let's look at today. So here, as far as my favored pattern, I don't know what the market's going to do tomorrow any more than the next person does. Nobody knows what's going to happen tomorrow. I love the people that come on and claim to know, but nobody knows. That's ridiculous. Nobody knows where the market's going to go tomorrow. What we do with Elliott Wave is we have a system that we have done the back testing. We have the empirical data that shows over decades and decades of data, of chart patterns, of analysis of our system, of starting with a pool from our confirming indicators rather than the market itself. So basically that's what happens. We use our confirming indicators to whittle the market down, the potential trades from thousands of trades to a handful. Then we apply Elliott Wave. So we're only looking at Elliott Wave on a small grouping of stocks rather than the vast universe of stocks that are available. The data shows that it works a good percentage of the time, more than it's wrong. So we are at some point going to actually do some releases on that AI data, share that with you. We're looking for the proper vehicle to do that. You can watch for that down the road. It's going to be pretty exciting stuff, but it's proof that this works more often than it doesn't. So my point is that I don't know where the market's going tomorrow. What I do know is what the Elliott Wave says, and I read the patterns. And since it's right more than it's wrong, unless we really screw things up, we should be able to generate a profit over the long haul. Can some people hit home runs in the short time that we missed? Yeah, and more power to them. But let's see where they are 20 years down the road with some of the craziness that's going on with the day trading in these days. But here's where we are with this pattern closing. So the question was, which do I think is more likely? Honestly, I don't know, because both patterns are qualified. We have the big downward flat qualified. We have the zigzag. Personally, I like the zigzag patterns. We've had this disqualification of the downward zigzag. So I would lean, personally, I would lean towards the potential for the upward zigzag. But there's a great case to be made that gap gets filled and then the flat forms, which is coming down to some sort of a near the lows. Doesn't have to test at the lows. The C wave can stop short. Doesn't have to go all the way down in a flat. There's several different scenarios for flats. That is a qualified pattern, and that could very well happen. If this gap gets fully closed, which it could easily do in the next couple of days. So if that gap gets fully closed, I think that upward zigzag pattern for the very short term has a pretty good percentage chance of occurring. But we'll know what happens once this gap gets closed. If the gap closes and it immediately reverses, then I think that's all we were doing, was going up and filling this gap in the reversal. We're going to head down and we're going to close this gap here and then work our way down and fulfill the flat. So that's my opinion. And my opinion means absolutely nothing, not really in the grand scheme of things. The way we trade is by what the charts tell us. We don't trade based on what my own opinion is, because the market doesn't care what I think. Couldn't care less what I think. So we trade chart patterns. We take emotions out. That's what you have to do to be successful over long periods of time. You can't trade on emotions. All right. So with that said, if I missed your question, I apologize. Here's one more thing, though. I do see one that I want to cover. Does Elliott wave cover the VIX? Because that actually was something that happened on the videos website. Is there was somebody that came on and got rather upset by the fact that I show chart patterns on the VIX, and their viewpoint was, well, since the VIX is based on futures contracts, et cetera, you can't trade the VIX. So when I talk about trading, I'm talking about trading options. That's what we do. We are Elliott wave options. We're options traders based on Elliott wave patterns. Our name says exactly what we do. And so you absolutely can trade options on the VIX. And when you have that kind of liquidity, and the options are very liquid, you have weekly options on the VIX as well. I think Elliott wave patterns are very prudent to look at on the VIX. So where the current pattern was this descending triangle. Now I drew the line there. I should have actually drawn it up higher, because that's where the line really was right here. And then it looked like we were starting to sneak to the downside, but then that was a false breakout and we rebounded higher. That's what I posted in the last video as well, was we had this big descending triangle, and it wasn't a very volatile breakout. You can admit it did look like it was sneaking out of the downside, and then boom. And I termed this sideways pattern to be like the launch pad effect. Live on Space Coast. But when stocks really go sideways, and they're going that sideways quite often, boom, the breakout or the thrust move or the impulse move, using all of Elliott's words there, is a vertical move to the upside. In this case, it was. And I mentioned that, well, we've had a big move. We'll see how far that goes. Well, it's reversed back down. The VIX is still elevated, though. I mean, with the VIX above 30, that's still, I mean, that's way high compared to where we've been over the last several years. But as far as where the VIX goes from here, that's challenging. We had the descending triangle. We got the breakout. What usually happens now is you need to let the pattern develop. Another thing that, and I'm glad you asked this question, because it gives me a chance to expand on this answer, as well as some people want to think that every stock, or at least the way the viewpoint is that every stock at every moment in time is in an Elliott wave pattern. Well, if you follow along with the new web series that we're going to do, I'm not sure when we're going to start it, but it's not in the not too distant future. The new web series that we're going to do on Elliott wave. So we're continuing on. We did the confirming indicators, which we then apply Elliott wave to. So we're going through that same process with the education. You're going to find out how intricate Elliott wave is and how much is applied to it. And not every stock at every moment in time is following along with that criteria. What we're trying to do is identify stocks that are within that criteria, so that that's when you have the higher degree of accuracy. You can't just throw on a program on any stock in any time frame. That doesn't work. We're looking for stocks that are going through a specific set of circumstances that, yes, were identified and programmed by a gentleman named Ralph Nelson Elliott. He's the one that put math to the theory, and that's what we're looking for. So we're looking for very specific things, not generalizations, very specific things. That's how you become successful trading Elliott wave over the long haul, not throwing up any chart on the screen and looking for a 1, 2, 3, 4, 5 on there. It's ridiculous. But a lot of people think that's what it is, and can kind of understand why maybe they haven't had the success that they think that they should have. BRKB. And then I've got one more to look at on the Aussie market. BRKB. Is that Interactive Brokers? Berkeley? Do you know what exchange is on? Berkshire Hathaway? Oh, that's because you have to have you got to designate whether you're A shares or whatever. Well, the average with the issue with Berkeley is with Berkshire Hathaway is it's so expensive that the average person can't trade it anyway. MSB on the ASX. So somebody had asked to look at this, so we will. So is that, you must be talking about BRK.D for, yeah, there you go. MSB is somebody asked me to look at this on the Aussie market. We have viewers and subscribers all over the world, which is really cool. So this is the stock, and I don't know what the liquidity is on the options here. It's a lower dollar stock than what we identify with on the website, but holy cow, if there's options around there, then that's what you want for breakout. Now the ADX is high. With that, you might be paying some inflated option prices if there's options available for it. So I don't know. You'd want to do some options analysis as well. But as far as the pattern, it's a really good symmetrical triangle that looks like it could break to the downside. But the DMI it's not giving any trend, which it shouldn't be with that pattern. But with the ADX being up there, the options may be a bit on the pricey side. So just be careful there with the liquidity and where the options may be. So there's your Berkshire. The .B makes all the difference. So Berkshire had a perfect wave 4 with a 62% retracement. So there's your Fibonacci 61.8% fib retracement. We've moved to the downside, and looking at the DMI for a further move lower down to the new low, you would certainly want to see. So in other words, if we ran a bearish search, this wouldn't show up because the DMI is not confirming this to the downside. As far as continuing with the pattern, the DMI isn't confirming it. So there you go. Hopefully we got to a good part of the questions, and in other words, the most likely pattern is that this kind of goes sideways unless that DMI changes, maybe fills this gap, but I don't see an impetus for it to go much in one direction or the other. Just this kind of looks more like a potential to meander sideways without a change in the DMI. But thanks, everybody. A lot of questions, a lot of really good questions, and appreciate your time. Hope you found that informative. Enjoy doing these things, and we look forward to talking to you again next week. We'll keep an eye on ZTO this week and the markets itself. Take care, everybody. Thanks for watching.